Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob. And we're treating everybody. You get to go a day early.
Yeah, how about that? We're Thursday today because, some things are happening on Friday that I've got to attend to. It's like looking after grandkids. So anyways, here we are. And it was an exciting day today. It started on the downside, and it was down into the close yesterday and then up and around. But anyways, in looking at the Dow, it was up almost 500 points at the close, or 2%. So it's a very good rebound in a steady, actually 2 legs down, because it was up to in early October, about October the 3rd is when that one peaked and came down, bounced, and then down to this low. So I think it's due for another bounce in here, but the bottom is not in yet. What we want to look at is some of the items that preceded the decline, and that was changing. Well, it was pretty subtle at first, but changing credit markets, where the yield curve took a turn for steepening. Many new people to the curve were looking for it to actually invert, where short rates get higher than long rates, and with our charts on the curve back to the 1860s, no, you can have a cyclical reversal without the curve actually inverting, which it looks like we've had. And then credit spreads also stopped narrowing in the summer, and then a number of weeks ago started to widen again. So you had that. So everything was being but supported by the firmer crude oil price. Now, years ago, we used to use a seasonal analysis on crude oil, and it would typically have an important high in the year in late September, early October. So this one, I think it was October the 3rd, so it was one of those highs at 77, and now it's down. It's had a good knock. And it was also part of the setback to the stock market and the setback to lower grade securities like junk bonds. They got hit in price. And of the mix out there, the utility index, the XLU, sort of came to life a few weeks ago and is up to 55, which was a high a number of months ago, and then the high last November. So we can call maybe the utilities a late bloomer, but they also may be a late failure as well, because it's a financial storm out there, Jim.
What should somebody do now? Do you think this is a permanent state of affairs, 2 steps down, 1 step up, 2 steps down?
Yeah, that's the way it's going to be. But when we look at historically with great financial bubbles, all the way back to the first one in 1720, they all suffered heavy liquidation problems in the fall of the year, sort of beginning in September. And then maybe Octobers were kind of ugly, and then everybody thought it was over, and then it would come down again, but more of a test in November. So this financial storm there's some seasonality to it, Jim, and we're patient in here. We called the break, but we're not calling the bottom yet, and there will be opportunities here. But I think the whole tenor of the market has changed, where all the way up it was buy the dips, and we had our technical indicator, which gives springboard buys on those dips. So then you go into the question of when is the last springboard buy? Well, there was one in August. And so what you have on that formula, Jim, is that when you take out the low on the last springboard buy, or the last buy the dip, then the whole formula has changed. So that was taken out, and we're in a very difficult market, because what makes it difficult is late speculators, those who are late in the game with enthusiasm and levered themselves up with margin, and they've applied that very enthusiastically. But if you're late on that, and you know, all it needs to do is go against you for a week, and then you got to run for cover, and if it goes a little further, then the margin clerks will sell you out if you didn't move quickly enough. So this is where the power shifts from the central bankers, who most of the time have the power to help financial speculation. But then when you get overdone and it starts to come down on the first stage of the contraction, the power shifts right over the margin clerks, and they have a vastly different job description to that of your basic central banker. The central bankers, in their reckless mode, they're out to keep everybody speculating in markets, which is getting the accounts offside. And then the tradition of a margin clerk, or the equivalent loan officer at a bank, is to get the accounts onside. So it's fascinating to watch the power change from supposedly with the central bankers to where the power really is with the margin clerks, and their job mandate requires a certain urgency. If the account is underwater, they get liquidated. Maybe the two terms, water and liquidity, go together, but it's been an interesting week.
We'll have more with Bob Hoye right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features to our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're speaking with Bob Hoye. Bob, the finance minister, is going to hold his annual financial update in November. What should he do to keep the Canadian economy on track?
There's nothing he can do. The historical aspect of great financial bubbles is that the excitement and the action in the financial markets feeds into the stock market or into the economy as well. And of course now you've got a double thing going on in the States, where since Trump took office, you've had a very pro-business administration, which followed probably one of the most anti-business administrations in American history. So now that has refreshed things a lot, with lower tax rates and more or corporate money coming back to the U.S. There's that's an added thing, but I think that is all in the market. So the idea of Canada with an economy a tenth the size of the U.S. doing something at the central bank to keep the economy going, when you look at it, Jim, it's an absurd idea it's an absurd idea to have a central bank in Canada because the country is so big that you say in Ottawa, where the central bank is, the Bank of Canada, and it looks at the economy in Ontario, which is the industrial base, and figures it has to work off of that. Well, what do you do with the Great Plains or the prairies where it's agricultural based, or more further into Alberta where it's petroleum based, or into BC where it used to be mining based? So even the notion of having policymakers in Ottawa setting economic policy for the rest of the country is absurd. And then to think they can set policy for a small economy like Canada's relative to the U.S. is another absurdity. So we'll just watch it with amusement and see what they do. And the media, of course, will be all over, like the latest rise in the bank rate, and they're going to do more rises they're talking about. But I think what we'll find here is that on previous booms and bubbles, short rates, like Treasury bills, go up in yield, and then when the boom's over, they go down in yield. So what happens is if you take the changes in the T-bill rate, which is determined by market forces, and you compare it to changes in the administered rate at the central bank, which, as that says, is it administered, you'll find that the administered rate follows changes in the T-bill rate, the market rate. So the central bankers are just faking it in all this talk about they're going to raise rates for the next 3 or 4 times or something, or over a certain period of time. If this break in the stock markets now follows through, the short rates are going to come down, and the next thing you know, that the Bank of Canada and the Federal Reserve System will be talking about lowering their administered rate and finding a reason for it. Jim, we're going to have fun watching the political nuances that central banking really is all about. It's all politics. When I think about it, that the idea of an intrusive, manipulative central bank, there are many different economic theories out there. There are theories that suggest that it shouldn't be tried. But of course, governments will always choose the theory that adds to their prestige and to their power and to their wealth. And central banking, intrusive central banking, does it because that helps the country to float huge amounts of debt, which has always got to be serviced and paid. So then they depreciate the dollar, the Canadian dollar, in order to make the payment easier. And then by that, they're, of course, screwing the bondholders, the people who are owning the bonds. But then maybe they've got considerations whereby they can't buy stocks. Sure, there's lots of fixed income only investors out there, and they get continually screwed by government policies. And as by the way, talking about bonds, the long bond in the U.S. or long Government of Canada bonds, they had a good technical low a week and a bit ago, and are beginning to rally. And I think the rally on the long bond could go, perhaps into December. So that's looking good. And what we should do as we wrap up, we can talk about some ideal places for investors to be in a potential storm.
We'll be back with Bob Hoye right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bobby. So we're in a stormy financial market. Where should we find a safe haven?
Hey, you sounded like Robert Newton in Treasure Island playing the part of Long John Silver. Indeed, gold treasure. But yes, one should always have some gold for an insurance. And you can make money out of gold stocks. That's the place we prefer to trade, but that's coming ahead of us. But an ideal place, before we get there, people are going to say, go to cash. Because if you go cash or T-bills, the equivalent, the interest rates there on the T-bills will go down as the stock market goes down. So you'll end up down to zero again on that one. So what you want to do is lock in some coupon rates, and we like the corporate bonds, good grade corporate bonds, and that removes the good grade removes some of the problems with risk. And then the other one, only go to 3 to 4 year term, and then that removes some of the risk from price change. And then because in previous post-bubble contractions, the senior currency trends up, and of course the senior currency now is U.S. dollars, so in going up, and you're long U.S. corporate bonds, you'll get reasonable safety, decent return, plus some extra from the U.S. dollar going up. It's not an exciting place to be, but it's a nice place to be, and that's a good safe place. But everything else, gold stocks, silver stocks, base metal miners, the oil patch stocks, they're vulnerable to these financial pressures, and you don't want to look at them until we're sure that the financial storm is over. And there should be some good signs on that, Jim, when this storm has run its course. So, and we'll be on deck, hopefully, for that one.
You'll be my anchor man.
There you go.
Thank you, Bob.
Good to be with you, Jim, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.